The night they thought they won, they took their best shot. They waited for the cover of darkness. They raised the margin requirements. They flooded the order book with paper shorts. They painted the tape red going into the weekend. For 48 hours, they wanted you to believe the silver bull run was over. They wanted you to believe the crash had arrived. They wanted fear to do the work that fundamentals could not. But when the sun rose over London this morning, the smoke cleared, and the bull was still standing, not limping, not wounded, standing. What we just witnessed was not a recovery. It was not a bounce. It was not relief buying. It was a message, because markets don't talk through press conferences. They don't speak through Fed statements. They don't whisper through analyst notes. They scream through price action. And what we are seeing right now, a massive gap higher erasing an engineered sell-off in a single session, is not normal market behavior. It is a scream. It is the sound of a bear trap snapping shut. It is the sound of short sellers realizing the metal does not exist. It is the sound of sovereign money replacing retail money. It is the sound of a 40-year suppression model breaking down in real time. If you panicked and sold into the drop, I have bad news. You were not smart money. You were liquidity. You were the fuel. But if you understood the game, you are watching vindication unfold in real time. Tonight, we are not making predictions. We are walking through the crime scene. We are dissecting exactly how the banks tried to kill silver and why, for the first time in 4 decades, their weapon jammed. This is the anatomy of a failed crash. The design of a bear trap. To understand the violence of this rally, you must understand the trap that preceded it, because nothing in financial markets moves in a straight line. Bull markets are not designed to reward conviction. They are designed to punish certainty. They exist to create maximum emotional pain for the maximum number of participants. And what we saw on Friday, that sudden brutal drop, was not random. It was textbook. This is how a bear trap works. The banks know where the stops are. They know retail traders cluster their stop-loss orders just below clean psychological numbers, $60, $62, $61, $50. These levels are not technical. They are emotional. To trigger selling, the market needs a catalyst. Not a real one, just a believable one. A margin hike, a hawkish headline, a vague risk-off narrative. They push the price just far enough. Snap. The stops fire. Automatic selling cascades. Red candles form. Fear spreads. At that moment, 2 things happen simultaneously. Retail sells. Bears pile in. And that is the moment everyone misunderstands. Because the banks are not selling to exit. They are selling to buy. They push price lower to manufacture volume. Then they absorb everything. They buy from the panicked seller. They buy from the overconfident short. They fill their bags quietly while the tape looks ugly. And then, once their artificial selling stops, reality takes over. Demand snaps back, shorts panic, they rush to cover. Their buying fuels the rally. This is exactly what happened. The drop was fake. The recovery is real. Weak markets bounce like dead cats. Strong markets bounce like Super Balls. Silver didn't bounce. It detonated. The margin nuke that failed for decades. The ultimate weapon against silver bulls was the margin hike. It worked beautifully in 2011. Margins were raised repeatedly. Speculators were forced to liquidate. Silver collapsed 30% in days. That single event scared capital out of the market for a decade. They tried the same playbook again. Raise the cost of holding, force selling through leverage stress, break the back of the rally. And for a moment, it looked like it worked. Price dipped, but then something unprecedented happened. The market absorbed the blow. Why? Because the market is no longer made of weak hands. In 2011, silver was dominated by leveraged speculators, 20x leverage, no balance sheet, no patience. Today, the dominant buyers are industrial users, family offices, sovereign entities, strategic stockpilers. These players are not gambling, they are hedging supply chains. When margins rose, they didn't sell, they wired cash. That single fact changes everything. When bad news fails to move price lower, it reveals strength so extreme it terrifies professionals. The banks miscalculated the pain threshold. They thought a margin hike would break the bull. Instead, it annoyed it. They fired their silver bullet, and now they're standing there holding an empty gun. The regret machine. Markets don't run on fear and greed alone. They run on regret. The V-shaped recovery is the most psychologically destructive pattern in finance. Picture the trader who sold Friday. He thought he was smart. He felt relief. He planned to buy lower. Then Monday came. Silver was higher than where he sold. Now he faces a choice. Admit he was wrong, or wait and hope. Most wait. Price climbs. $65, $68, $70. Regret becomes FOMO. Eventually, they buy back at the worst possible moment. This is how trends accelerate. This volatility was not damage, it was cleansing. Leverage flushed, sentiment reset, trend intact. A structural bull market disguised as chaos. The London pivot. Here is where the story becomes historic. For 40 years, London was the seller of last resort. Whenever New York panic bought, London calmly sold. But this morning, London didn't sell. London panic bought. Aggressive bids, no offers. A complete change of character. Why? One word: float. Inventory is not supply. Float is supply. Most of the metal in LBMA vaults is owned. ETF metal, sovereign metal, long-term storage. That metal does not move. What sets price is the dealer pot, and that pot is empty. Years of Asian accumulation drained it. India didn't buy ETFs. China didn't buy paper. They bought the float. London looked into the pot this morning and found nothing. That's when panic starts. The leasing machine breaks. Silver suppression depends on leasing. The same ounce leased again and again creates the illusion of supply. But leased silver gets consumed. Solar panels, electronics, defense systems. Consumed silver doesn't come back. Now industrial users can't return metal. Lease rates spike. This is the market screaming shortage. Banks now have silver on their balance sheet. That does not exist in the vault. They must replace it. They don't care about price, they care about survival. That is the London pivot. The silent bank-run unallocated accounts are fractional, always have been. When clients demand allocation, metal must be removed from the pool. That removes float. Enough requests. The system breaks. This rally is not retail mania. It is billionaires sending legal notices. A bank run without a line. The $65 kill zone. $65 is not resistance. It is liability. Options exposure is massive. Above $65, market makers must hedge. Their hedging becomes buying. Buying pushes price higher. Higher price forces more buying. Gamma squeeze. Above $65, defenders become fuel. The American, wake up. The US Open is usually where rallies die. But today, Americans see green. They chase. ETF inflows force physical buying. The dollar may try to fight, but if price holds, the defense has failed. The miners lag at turning points. Fear delays equity buyers, but math always wins. If silver holds, miners must catch up. That snap is violent. The year-end pain trade. It's December. Funds must report holdings. Silver is the winner. Funds without silver look incompetent, so they buy at any price. Window dressing is real, and it creates parabolic moves. Why the pain trade is up. Ask one question. What outcome causes the most pain? A crash hurts believers. They don't sell. A rally hurts banks, industry funds, and cash holders. That's the pain trade. That's where markets go. The structural shift. This 1.60 move matters. It confirms the wealth transfer from paper to physical, from promises to atoms, from finance to reality. You cannot print silver. You must dig it. Friday was a test. Monday was the answer. 3 final takeaways. 1. The bear trap failed permanently. 2. London switched sides. 3. The float is gone. Final warning. Volatility will increase. Weak hands will be shaken. Leverage will be punished. But the trend is intact. If you understand this shift, you are early. If you don't, you will chase. Subscribe. Hold. And remember, the market already told you the truth.